Welcome back to another episode of Global Insights for Tax Leadership, your go-to video series for relevant topics impacting the tax profession. Again, whether you're a seasoned tax professional or simply somebody looking to better understand the complexities of the tax world, I'm hopeful this series is designed with you in mind. So, pretty exciting today. We're on to our fifth episode, and this is going to cover the impact of One Big Beautiful Bill Act, or OB3 or OBBA, depending on how you look at it, and how that bill is playing into accounting methods. And we're also going to take a bit of a deep dive into changes to IRC Section 163J. So, if you're enjoying the series or you're brand new to it, please give it a like or comment on LinkedIn and YouTube. For those of you that have been watching along, and for those that are new, I'm Jeff Burns, a lead tax partner in KPMG's Business Tax Services practice based here in Chicago. And with me today, I have one of my good friends and partners, David Schneider, is also in our Business Tax Services practice, but David focuses more on accounting methods and credits, and he's also based here in Chicago. David, thanks for joining me today.
Oh, thanks, Jeff. It's a pleasure to be here, discuss this with you, and be part of the fastest growing video tax series in the nation, I believe.
I appreciate that, David. So, where I want to start is talking through just a general overview of OBBBA and some of the high level impacts that you're seeing from an accounting methods perspective.
Absolutely. There's quite a few changes that are before us right now. Most of the accounting positions and changes are effective for tax years beginning on or after 12/31/24. So effectively, for calendar year taxpayers, we're looking at changes in 25 that you can make right now for this current tax year. OB3 makes permanent a lot of the expiring provisions of the Tax Cuts and Jobs Act. For instance, it brings back and makes permanent the 100% expensing of current R&D. It brings back depreciation, amortization as an adjustment to adjusted taxable income for the 163J limit purposes. And then it also brings back 100% bonus depreciation, makes that permanent. So we've got a lot of things that are giving taxpayers more certainty now that things are permanent. Remember when they made TCJA, made Section 41 permanent. And so taxpayers now have a little more certainty than they did before. Looking specifically at some things, some changes that are on the horizon, a big change in the 174 space for domestic R&E. We've just had this period of capitalization of the R&E, and you capitalize it and amortize it over 5 years with the half-year convention. OB3 makes permanent the 100% expensing, if you'd like to, of the current year R&D. You also have a provision to capitalize the R&D over a period of not less than 60 months. But the kicker here and the big change from the prior law is that it doesn't go into effect. That amortization period doesn't start until the taxpayer is first realizing benefits from the intangible that they created. So if you're a pharmaceutical company and you're doing research on drugs, boy, that could be 5, 10, 20 years out before you really start realizing the benefits of that research. So if you elect to capitalize under that provision, you keep in mind, depending on your business, there could be a long time till you recover those expenditures. And then, fortunately, we still have the flexibility of 59E. If you remember 59E, that allows us to capitalize the R&E expenditures over a period of 10 years. Now, that is irrevocable, but that provides the taxpayer a lot of planning. So you have really 3 different options with respect to 174 costs incurred in 25 and going forward. But then the question is, what are we going to do with this capitalization that we have built up from 2022 through 2024? The service has given us a couple of things that we can do. We can just let it bleed out under the current amortization period, which is 5 years, or we can go ahead and take the benefit, that is expense, the unamortized portion all in 2025, or split it equally between 2025 and 2026. In addition to that, bonus depreciation, we've got 100% bonus depreciation that's made permanent. That's fantastic. Under 163J, we have the 30% limit that is permanent, and the depreciation amortization that's back. So your alternative taxable income, for purposes of determining your 163J limit, is going to be increased now by depreciation and amortization. So those taxpayers that are in heavily capitalized industries, they're really going to benefit a lot from that provision. The disallowed interest carry forward from prior years, it's very clear that that is not going to be allowed to be capitalized um, in the current year. And also, they took away the provision that allowed us to take the elective provisions of capitalization before the mandatory provisions, i.e., the 163J limit. For 2024, 2025, those tax years, we can still capitalize interest cost to something like, cost of goods sold, inventory, fixed assets. It loses its character and it becomes, depreciation, amortization, and we can get around the limitation for those 2 years. But going forward in 2026, uh, we're going to treat any capitalized interest as subject to the 163J limit first and foremost. So it effectively eliminates that kind of planning. But fortunately, we have some thoughts on um, how to make up for those lost deductions through capitalization. Most of the international provisions kick in after 2025. Um, I just want to touch on one. FDII, the foreign derived intangible income, is now going to be called the foreign derived deduction eligible income. And there are some small changes to FDII. Essentially, we're going to get a 14% effective tax rate, and we're no longer going to allocate interest and R&E. Once again, that's starting in 2026 going forward. And if you outbound IP, that's not going to qualify for the lower taxable rate of FDII. Generally these changes are very taxpayer favorable in my mind, but the pitfall is if these are too favorable for you, you might be backing your way into the CAMT, the corporate AMT tax. And we all know once you're into CAMT, you don't get out. So we got to watch out for that.
Yeah, and that's interesting, David, because as we think about, what's kind of come through in terms of making, prior TCJA rules kind of permanent, and then, looking at some of the other changes in OBBA, there is quite a bit of interplay across those different aspects of the legislation. And so I think, as we think about that, what are what are you seeing or thinking about in terms of how companies should be thinking about this as they look at elections and kind of other planning, because there is that kind of fine line about how you look at each of the different components.
You're exactly right. I view it as a balancing act between cash flow and permanent tax savings. And you really have to ask the taxpayer, what do they want? A lot of my taxpayers, my clients in private equity, they care a little bit more about cash than effective tax rate reduction. Um, and that's particularly important when you think about if I'm in a heavily capitalized industry and doing a lot of R&D, I built up this unamortized 174. If I expense that all in 2025, like you might think, hey, if I can expense it, great, let's do that. Well, you're going to lose your 250 deduction, or at least you might lose a portion of your Section 250 deduction. Is that good? Is that bad? Do you want the cash? Do you want the permanent benefit? It really comes down to being a modeling exercise. And if you're looking at losing the 163, at least a little bit of the 163J benefit because you can't capitalize interest, are there some avenues you could go down or some levers you could pull that could make up for that lost ground? And I believe these rules allow us a flexibility to do that, to find alternative ways to minimize the impact of that 163J limit. The 174 changes are really interesting. Um, we used to have a lot more flexibility when we could just capitalize under not less than 60 months. Now we've got this little ringer in there that says not until you can't start amortizing until you realize those benefits. That's really going to vary taxpayer by taxpayer and depending on their industry and the facts and circumstances. Keep in mind with 59E, you can pick a specific dollar amount. If I'm looking to increase taxable income by $110, I can do that through 59E. Conversely, 59E is irrevocable, but at least it's not a method change. That capitalization under 174, not less than 60 months. It used to be you could pull the lever each year, decide, yes, I want to capitalize, no, I want to expense. Now, once you pick a capitalization, that is your method going forward. And we got to get the IRS permission to change that. Um, you can't use the automatic within a 5-year period. So there's some very important things to consider. You know, Stepping back, if you just think about organizations, and you might have under your current structure, you might have IP taken out of the U.S. You might have contract R&E being done in the U.S. such that you're getting a 162A deduction, ordinary and necessary, because it's contract manufactured. Maybe it makes sense to look at the structure and say, we don't have mandatory capitalization of 174 expense anymore. Bring that back to the U.S. So now it is subject to 174. We can still immediately expense it, but most importantly, it's not going to be allocated to your FDII starting in 2026. So that's a good thing. So if you could change, even if you look at your manufacturing processes, if you're currently just saying, oh, it's all cost of goods sold, 162A, maybe some of those expenditures are 174. And therefore, they're not going to be reducing your cost of goods sold related to your FDII exports. So there are really quite a few things that taxpayers can think about and analyze.
Yeah, and I think you did a great job of hitting those interplay areas that you have to think about what you do in one particular area and how that has a ripple effect to those other areas. So there's a lot of calculative or quantitative aspects to it, and qualitative aspects to your consideration. So one kind of last area I want to maybe spend a minute or two on is 163J. Can you maybe talk just a little bit, you hit on it before, but maybe talk a little bit more detail around 163J and what companies should be considering in terms of planning in light of, OBBBA and some of the changes there?
Sure. Well, 2025 is going to be a very interesting year for taxpayers. That's a year in which we can still capitalize interest to avoid the limitation. The last year we can do that, but at the same time, the government's given us depreciation and amortization as add backs to ATI. So if you think about combining that with 100% bonus depreciation, if we could create depreciation amortization through capitalization of, say, G&A costs to fixed assets, and then immediately expense those fixed assets on using bonus depreciation, then we're going to create this add back to ATI and lift the limitation. So it's a capitalization exercise. You're going to look at 263 little a, to the extent that I've got costs related to fixed asset purchases under 263 little a-2. That's an interesting play there, because that's not a method of accounting. You're not stuck with it. If you go to 263 cap A, that is a method of accounting. Both of those are provisions for us to take G&A, procurement, overhead costs, and tack it on to the cost of the property that we're acquiring. They're just different ways to do it. And one is an annual election. Another one's a method that you may be stuck with for 5 years. So there's a lot of planning that we can do in the interest space. And very importantly, remember, the government took away our ability to capitalize interest for the limitation only. That does not preclude us from capitalizing whatever interest is remaining after the limitation, we can use the capitalization provisions there to reduce BEAT, to increase foreign source income, um, for reverse tax planning. So that planning lever is not dead. It's dead for purposes of the limit starting in 2026 and going forward.
I always end with kind of this one final question. What's the one thing you want to leave the audience with, and where should companies be focused today?
I hate to say it, but it's all a modeling exercise, and it is going to vary. I have taxpayers that are in asset management. These rules are hitting them far differently than industrial manufacturers. It's just going to vary by taxpayer based on your individual facts and circumstances. So you got to get out the modeling. You have to have a very keen insight into your tax forecast, and then do the analysis with when the rules are changing, when they're effective, and how they impact you.
So it's modeling, and then I think it's a lot of the considerations and commentary you provided today, layering that technical overlay onto it. So fantastic answer, David, and I appreciate that. So we're going to close out today, but David, I can't thank you enough for your time. I really appreciate it, and I'm so glad to have you on the video series here today.
Thank you very much, Jeff. Have a great day.
Well, look for our next video in the series, and I appreciate the continued support. And another reminder, as you see the series on LinkedIn or YouTube, please give it a like, comment, or share. Thank you so much.